Good morning everybody and welcome to James Cowper Kreston's Spring Budget Seminar 2023. For those of you who don't know me, my name's Alex Peel and I'm Joint Managing Partner at James Cowper Kreston, and today we're going to take you through some of the key aspects of yesterday's budget. I'll be joined in a minute by my business tax partner Alex Nicholson, who's going to take us through some of the key changes or the key points that were outlined, and then after that we've got a panel discussion where I'll be joined by a number of other colleagues who will discuss some of the various aspects of the budget. Those of you who've joined us before for these sorts of things will know that we like to be fairly interactive and ask you questions as well. So through the event today there will be a couple of polls for you to take part in, and more about that later. And you'll also have the opportunity to ask us questions as well and put your questions to the panel who will try and answer those. On your screen today, you should also be able to see various links on our website. We've got a summary of the budget and some of the key points arising. And later on today, a recording of this presentation will also be on our website. So do go and take a look there as well and find out more information there if that's what you want to do. Before we get going then, I mentioned that there would be a number of polls today, and before everybody sort of has a chance to drop off or get distracted by emails or whatever it is people might be doing, let's move quickly on to the first poll question. So the first poll question this morning is, do you think the announcements in the budget are good, bad, indifferent for you and your business, first of all? So do you think that the announcements in the budget are good, bad or indifferent for you and your business? So if you could cast your votes, that would be really good. I'll give people a few seconds to do that, a minute or so to do that perhaps, and I can see the results coming up on the screen, moving all over the place at the moment. So it's a bit like a horse race this, with several racing into the lead and then others catching them up. So we'll give you another 10, 20 seconds or so to vote. The votes are coming in. Quite a few of you have voted. I think a few of you are already on the emails or looking up what you might be having for dinner tonight or something. So if you get those votes in, okay, 5 more seconds. Stop moving quite so much. So we'll close that poll now. So the results then of that one, so 24% of people thought that the measures were good. Only 9% thought they were bad, which is interesting. But 67%, so the overwhelming majority of people thought that the measures announced were indifferent for their business or themselves. We'll quickly move on to the second poll question. So same question really, do you think the announcements in the budget are good, bad or indifferent for the UK as a whole this time? So thinking about the country as a whole and where the country is, what do you think? So if you can vote again, that'd be really good. Get your votes in there. We'll give people 30 seconds or so to vote again this time round. And it'll be interesting to see what the results are for the UK compared to ourselves and our businesses that we're working in on a day-to-day basis. So those votes are coming in there. Hopefully it's not too difficult a question this time of the morning. And we'll give people sort of 10 seconds or so to get those votes in. Again, it's moving around all over the place. Interesting this time, actually, from what I'm seeing, it's slightly different result. So we've nearly got as many votes as last time, so we'll 5 more seconds. And the voting has stabilised, which is always good. So we'll cut that there. And yeah, very, very interesting. So this time round, so last time round, 25% of you thought that it was good for your business or for yourself. This time 44% of people thought it was good for the UK as a whole. Only 11% thought it was bad for the UK as a whole, and the rest thought it was indifferent or didn't really make too much difference. So that's really interesting. So thanks for that. It's interesting to see people's views. So that's good of you to give your view. It's always interesting on days like this to see what the papers think of it. I think this budget had been billed as a boring budget, and that was sort of done intentionally. I think some commentators seem to think it was interesting, before the budget started yesterday, obviously they had Prime Minister's question time, and Keir Starmer had the opportunity to talk and ask questions about what might be in the budget, but actually he decided to focus on Gary Lineker instead, and what Gary Lineker was up to and what he'd been tweeting. So he didn't go straight into the budget. So quite interesting then to see that actually the Daily Telegraph, if you look at the front page, you wouldn't actually see very much at all about the budget, because they focused on the Swiss banking crisis and the global fears and what might happen if there's another banking crisis like we saw a few years ago. And of course, if we do have that, then it's possible that yesterday's budget might have to be rethought, and people are already talking about reforecasts for the economy. So Daily Telegraph, yeah, you've got Budget 2023 at the top, but didn't make the headlines. The Times, Hunt waves through biggest tax burden since the war as their headline, and perhaps we'll come on to that a bit later. The Guardian, giveaway for the 1%. So thinking that it's better for the very well-off people and perhaps not others. And then we get on to, who have we got next? We've got The Sun. Tanks a lot. It's a good one. Drivers save £100 a year on average after a 12p rise in fuel duty axed, and we'll come on to duties later perhaps. We've got the Daily Mail. Is it enough to turn the tide? But they're also referring to stealth tax raid over the next 5 years again. Tory MPs wondering if it will be enough to save their jobs after the next election. And then the Daily Mirror, pots for the rich, comes back to the theme that actually it's very good for people who are well off already, but perhaps not others. I couldn't get a copy of the Daily Star this morning, but I did see their headline. They're always good value on these sorts of occasions. They didn't lead with the budget at all. Their headline was, "It's a long shot," and referring to the tallest jockey ever riding at Cheltenham today, apparently. You had to go all the way through to page 7 of the Daily Star before you could read about the budget. So anyway, so perhaps a bit of a mixed bag there, perhaps not some of the headlines that we've normally expected. So anyway, without further ado then, as I mentioned, I will now hand over to my partner Alex Nicholson, who's going to take us through some of the key changes that were announced yesterday. Thanks, Alex.
From one Alex to the next. Thank you, Alex. So, as Alex has said, I'm just going to present on some of the mainstream tax measures this morning, really just to sort of run through them. So I won't be going into all those, I guess, important announcements that were made yesterday, such as, for example, the extra £200 million that's going to be made available to fill in some potholes. When we were discussing it yesterday, one of my colleagues actually commented immediately afterwards that the whole of the 200 million would be needed in Wokingham, so bad luck if you don't live in Wokingham. So once I've finished running through the measures, then obviously I'll hand over to the panel and they'll get into the detail. So if I could have the next slide, please. So I just wanted to take a moment really to recap on where we are with personal tax allowances and thresholds. There weren't any major announcements, in fact there were no significant announcements made yesterday, but it's just, I think, important just to recap on the fact that really most of these allowances and thresholds are frozen through to April 2026. So for example here you can see then on the screen we've got the personal allowance still at 12,500, current tax year, next tax year, year after. The higher rate threshold, that still kicks in at just over 50,000. And the items on bold here on the slide are the ones where there have been a few changes then, not announced yesterday, but announced previously. And of course that was Jeremy Hunt back in November, I think it was, when he announced that the additional rate threshold, that's the point at which people start to pay 45% income tax, would come down from its current limit of 150,000 to just over 125,000. And that, of course, will remain the case as we go forward. He also announced that the dividend annual allowance will be decreased from its current level of £2,000 down to £1,000 next year and £500 the year after. So the dividend allowance, of course, is the amount of dividend that you can receive and not pay any income tax on. The CGT allowance, again, it's an allowance. It's the amount of capital gains that you can realise in a tax year and not pay any capital gains tax. That too has come down, or is coming down, from its current level of just over 12,000. It's then halving to 6,000, and as we go into 24-25, it's going to come down even further to just £3,000. So there are some significant sort of tax rises that actually come into the mix in all of those measures taken together. As I said, no change to the main rates of tax, 20%, 40%, 45%. Dividend tax rates, I've put here that strictly they're going up by 1.25% from April 23. Actually, it's maintaining the rate that they're at in the current tax year. It's just that actually they were supposed to revert to their previous level, but that's no longer going to be the case. So technically they're staying at the same level, but technically they're going up. So I think that's all I'll say on that slide. If I could have the next one, please. I thought it probably important just to run through some of the pension changes. Of course, this has probably been one of the things that's really has been picked up in the press to the extent that you've seen that. And of course, I think Alex was just talking through some of the headlines. I think this is what underpins some of those headlines as well about the tax cuts for the wealthy. So the annual allowance, which is the amount that most individuals can put into their pension every tax year, is going to go up from next April from its current level of £40,000 a year up to £60,000. So obviously you can then put more into your pensions. At the moment, there's a lifetime allowance on setting out the total amount that you're able to put into your pension, and it's just set at just over £1 million. Yesterday, the Chancellor announced that he's going to abolish that altogether. So that means that, in theory at least, you can actually, indefinitely accrue more and more pension benefit and not suffer prohibitive tax charges from doing so that currently apply. What happens, of course, in practice is for very high earners is they're not able to put in that 40,000 or 60,000. And the reason for that is that annual allowance is actually tapered, so it reduces as the income goes up. The threshold from which that's going to apply is actually going to increase from next April. So currently, that tapering starts if you earn more than £240,000 a year, but from April it's going to go up to £260,000. So you then get to the top of the tapering, and currently when you have an income of, I think it's £312,000, you're capped at being able to only put £4,000 a year into your pension. That's going to increase to £10,000 from next April. However, because of the increase in the level at which tapering starts to apply, and because that tapering works on a £2 for £1 of income basis, it actually means that full tapering will only apply to those on very large incomes of above 360,000. So actually there will be some benefit for some quite well-paid people here who currently can only put £4,000 into their pension scheme. They will be able to put in a bit more next year, and at least 10,000. The other thing that was mentioned as being a positive, I think, in trying to get people back to work is this raising of the money purchase annual allowance, which is also being increased from its current level of £4,000 to £10,000. And this is the amount that you can put into your pension scheme if you've actually already drawn benefits from it on a flexible basis. So the idea is that will hopefully make it more attractive to get people to come back into the workplace and to then be able to make some pension contributions. One point I just picked up here on the slide, actually, it's this last point here, which I haven't seen mentioned particularly in the press, is that when you draw your pension, you can obviously take 25% of it currently tax-free. But actually, although the lifetime allowance is being abolished, or the lifetime limit, the amount at which you can take tax-free is not going up in the same way. So actually that's going to be capped at its current level, which means that for someone who's got the full 1.7 million in their pension at the moment, they can take £268,000 tax-free. But as the pension amounts go up in future, that figure is still going to be capped. The next point on the slide here then is around childcare. I just wanted to make the point really that whilst there was an awful lot said in the budget about free childcare yesterday, that's the childcare that applies to very young children. There were no changes made to tax-free childcare as far as I could see. And that's obviously applies to older children as well, and it is effectively the government giving tax breaks to working parents of up to £2,000 per year per child, so that remains the same. The final thing on this slide before I move on then is just a brief mention about divorce, a sort of small but welcome measure here. Generally where couples get divorced at the moment, if they want to transfer assets between them on a tax-free basis as part of splitting, they can only do that really for the 1 year after they separate. That's going to increase to 3 years unless their divorce proceedings take longer, in which case it's extended. Next slide, please. So moving on then, away from personal tax to VAT and duties. The VAT threshold, I thought again it's just worth mentioning that also is frozen through to April 26, I believe, and that's at £85,000, so no change there. There were no mainstream VAT changes announced yesterday, so lots of small tinkering, but no major new measures announced. Fuel duty, I think, as Alex has sort of already mentioned with one of the newspaper headlines, the 5p per litre relief has been extended for a further year, and there's also no RPI increase, which is where the, I think, 11p a litre that Alex mentioned came from. Alcohol, tobacco, vehicle exercise duties, air passenger duties, all of those are going up, typically in line with RPI. Obviously, if you're a smoker, that's not the case, and I'm afraid there's bad news for you. I think it's always been the case for many years that the tax on these sin taxes, I think they call them, seem to go up by more than RPI increases, and I'm told that a packet of cigarettes will now cost nearly £15, which is seems a huge amount of money. Much was made in the speech yesterday, I think, about the duty that applies to draft beer that's served in pubs. That's going down by 11p, which basically just means that there's less duty on a pint that you have in a pub compared to a supermarket. I'm sure that won't be passed on to consumers, but it's obviously welcome relief in terms of trying to get improve the profit margins of some pubs and things which are struggling at the moment. I think that's probably all I'm going to say on that slide, so if we can go on to the next slide, please. So we now move on to corporation tax. Obviously, it was confirmed yesterday that the increase in corporation tax from 19% to 25% will go ahead with effect from the 1st of April next year. There had been intense lobbying going on in the press over recent weeks, calling for that not to happen and for the 19% rate to be retained. I think it's worth pointing out that actually the 19% rate is retained for some companies where they've got small profits, and that's what this table is seeking to show here. So actually, if you've got a company and it's only got profits of up to £50,000 in a year, the 19% tax rate still applies. The 25% tax rate applies once the profits get above £250,000 per annum. But in between, we've now got what you call marginal relief, which is effectively where the rate steps up from 19 to 25%, but it actually creates a higher marginal rate. So profits in that band between 50,000 and 250,000 will be taxed at 26.5%. So obviously that's going to be a significant increase for some businesses, but the government estimates that actually only 10,000 companies are expected to pay the full 25% rate. I think that misses the point that there will be an awful lot of businesses between 50 and 250,000 that are suffering that higher 26.5 marginal percent tax rate. I've also mentioned on there loans to participators. This is generally the case where most sort of SMEs make loans to their shareholders or their directors. If they don't pay that back within a certain time, the company actually has to pay over tax to the revenue until such time as that loan has been repaid or discharged. And that's now going to be at the sort of higher dividend rate of 33.75%. It's one to watch. It does sometimes catch clients unawares, and it's quite expensive, albeit that ultimately it should only be a cash flow issue because you do eventually get that tax back if you claim it once the loan has been repaid or discharged. The next point on the slide, tax relief for the creative industries. There were quite a few announcements there yesterday. I wouldn't profess to understand the detail of those, although I did pick up that the way it works for film tax credits, audiovisual is going to change to an expenditure credit. And I think that's probably something that we'll pick up in the panel in a minute. The final point on this slide, share scheme changes. Not a lot I want to say around that really, other than to say that there were a few welcome changes announced that simplify a couple of administrative matters around enterprise management incentive share option schemes, for example. If I could have the next slide, please. So I thought it was probably worth just spending a minute talking about a question that I very often get asked by clients. So this is clients who have their own company and they want to know whether they should take some additional remuneration as bonus or as dividend. And the historic answer to that has been that the most tax efficient route has typically been to take a small salary that typically uses up the personal allowance and then to take the rest as dividends. And that's been the case for a number of years now, and it has been the most tax efficient position really, whether you were a basic, higher or additional rate taxpayer. Well, that changes where your company is going to be subject to 25% corporation tax. So the landscape is different there now. And on the slide there, I've tried to sort of highlight the differences really. So if you are a basic rate taxpayer and your company is paying tax at 25%, taking a dividend is still more tax effective, significantly more tax efficient here. You can see 31%, or 31.5% versus 40%. However, if you're a higher or additional rate taxpayer, the position actually reverses going forwards, and it's going to become slightly more tax efficient then to take salary and bonus ahead of dividend, i.e. which is the point that has historically been the case. I also make the point here that there really is no one size fits all. When it comes to remuneration planning and strategy, there's lots and lots of different factors that come into play. And you know, wider family and personal circumstances, the fact that lots of companies, of course, won't be paying the 25% corporation tax rate. And there's a range of other ways of taking money out of a company, for example, pensions or tax efficient benefits in kind. Electric cars remain very, very tax efficient and will continue to be for a number of years. So that's something to consider if it would suit your lifestyle. So the optimum position is dependent on a range of factors, and it's always worth taking advice to work out the most tax efficient solution for you. Next slide, please. Another of the announcements yesterday then was around capital allowances, or the full expensing relief as it was called. Just as a reminder then, capital allowances are a tax relief that businesses get on their capital expenditure, typically on plant and machinery and on some buildings, etc. And this is because they don't get tax relief for depreciation, so tax relief is instead given through the capital allowances regime. So currently all businesses benefit from an annual investment allowance of £1 million. So they can spend up to £1 million a year on most plant and machinery. It excludes some things, for example, cars, and they can write that off in full for tax in the year that they spend the money. And that's all businesses, so that's partnerships, sole traders, as well as companies. So this new relief that's been announced, full expensing, is for companies only. And again, it effectively gives full tax relief. It's just that it's not capped at £1 million. So it really is aimed at large companies, or at least capital-intensive businesses. And yes, so it gives 100% deduction for the cost of certain, I put on there, plant and machinery from profits. Again, there's certain exclusions from that, for example, cars, but also anything that wouldn't go into your main rate equipment pool is excluded from this allowance, and it will only get a 50% allowance. So that would be a lot of the things, for example, if you were to fit out a building and you were to install electrical systems and heating systems and things, they're not going to qualify for this full expensing as I read it, because those would go into the special rate pool, and therefore you'll only be able to expense 50% of that unless you can claim the annual investment allowance on it. So it gets quite complicated. There's a range of regimes, but I'm sure that this will be welcomed by big UK corporates that obviously spend significantly more than £1 million per year on their capital equipment. Just a point to make before I move on, that actually if you then sell some of those items, you do then need to bring in those disposal proceeds as a taxable credit, going forward. So you're going to need to maintain records in order to track that. And the final point on the slide there really is that a lot of people will have been aware that there's been this super deduction available for the last couple of years that disappears at the end of this month. What this full expensing seeks to achieve actually is very similar in its effect to what the super deduction does currently. And you can see on the slide there, effectively it's giving a 25p tax saving for every pound that's spent. And when you do the maths on the super deduction, but with the lower corporation tax rate, you get to the same position. Next slide, please. So finally, really, I just wanted to wrap up. I've got a couple of slides on R&D tax credits. And I thought across our client base, we have a huge number of clients that do benefit from and claim R&D tax credits. So I thought it was worth spending a few minutes just talking about quite a major change that was announced yesterday, but also a whole raft of other changes that are coming into that regime. And the first point on the slide there talks about the R&D landscape changes. And that really, I just wanted to highlight the fact that HMRC are taking are starting to take much more interest in an awful lot of R&D tax credit claims. And the reason for that is that there's, we're told, a huge amount of abuse in the system, and they're basically stamping down on it. So the R&D landscape is very much changing. And as we go through these measures, you'll see sort of some of the impact of that. So just a quick reminder then of the announcements that were made, I think, back in November again, which was actually reducing, well, sorry, for SMEs is reducing the benefit of the current R&D tax credit regime, where the current 130% uplift that you get in costs is being reduced down to 86%. So if you spend 100,000 previously, you could, on qualifying costs, you could take a deduction against your profits for 230,000 in total. That's now only going to be 186,000 from next April. The other side of that is the RDEC, which is typically claimed by large companies, although it does apply to certain SMEs as well, most notably where their R&D work has been grant funded or otherwise subsidised. So it was announced that was going to decrease significantly, which I think again is aimed at sort of trying to stop it being so attractive to combat fraud. But of course, in doing that, it then takes it away from all those genuine claimants. Sorry, I think I've just slightly lost my way there. I was talking about the RDEC, but the RDEC is increasing, the SME one is not. So moving on then to the measures that were actually announced yesterday, which was around bringing back some of that SME R&D benefit for R&D intensive SMEs. So where we've seen those reductions in rates and therefore a reduction in the rate of the payable tax credit that they can get back, this is looking to sort of bring that back for these R&D intensive SMEs. So it's going to only be available to loss-making companies. So if you're already trading at a profit, this doesn't apply to you. And basically, it will also only be available where your R&D expenditure accounts for at least 40% of the total expenditure of your business. So that's the R&D intensive definition. And for these companies, effectively, the current credit rate of 14.5% is being retained. And what that all sort of washes through to, with the tax rate changes, etc., is that the payable credit will be equal to 27 pence for every £1 of expenditure on eligible R&D. So that's that slide. Next slide, please. And then just a very quick canter through some of the other R&D tax credit changes before I then hand back to Alex. So this is this sort of whole raft of new measures that are coming in, generally from April 23, but some changes, as we'll see as we run through these. But there are some new categories of qualifying costs that are coming in that can be included within R&D tax credits going forward, in specifically data licenses and cloud computing services, which many businesses who need those services to undertake their R&D have felt for many years that it was unfair that they couldn't claim them. That's being rectified, so that's good news. The definition of R&D is being expanded slightly so that it can include all mathematics, pure mathematics as well, provided, of course, it meets the wider definition of eligible R&D. And one of the restrictions that has been announced previously is that it's going to be much harder to claim overseas subcontractor or externally provided workers' costs in your R&D tax credit claim. And basically you won't be able to include them unless you really couldn't get it done in the UK. That's the core test. So that was due to come in from April this year, but actually they've announced that that will now be deferred for a year and won't come in until April 24, which is good news for quite a number of my clients who rely heavily on overseas subcontractors. Some of the more major changes then here actually, and this again is these are measures aimed at stopping abuse of the system, is that there's going to be a requirement to notify that you want to claim R&D tax credits within 6 months of your year end, unless you've actually already made a claim in the last 3 years. And this is to, I suppose, almost sort of stop the ambulance chasers who come at it as late as possible and then try and make backdated claims. Not that you have the ability to go that far back in reality. So that's a new measure. And then also from the 1st of August this year, every single claim that is submitted to HMRC will need to be accompanied by what the Revenue are calling a new G form. And fundamentally, this is aimed at gaining additional insight as to how the claim has been prepared and making the company more accountable for its claim. Because I think one of the things that the Revenue have been concerned about is that there's an awful lot of R&D advisors out there who are very good at curating a good narrative and are submitting claims that the companies themselves have had very limited involvement with. So one of these measures is that all claims must be endorsed by a named senior officer at the company. So that is quite a significant change actually, and as I said, it's all around driving accountability. So the final point on here, which is a watch this space really, is that the government has announced that it's looking to merge the RDEC and the SME schemes, as I seemed to in my mind a few minutes ago. So that's to come, and it's a watch this space. So I think that concludes all the tax measures that I wanted to cover. So I think without further ado, I'll hand back over to Alex. Thank you.
Really good, useful summary, which hopefully we're going to pick up on some of the points now. So I'm joined now by Sharon O'Mackay, who's Head of Private Client Services at James Cowper Kreston, Mira Raja, who's Head of Indirect Taxes at James Cowper Kreston, Phil Snell, who's Business Tax Partner, and Alan Poole, who's an Advisory Partner and Head of Technology at James Cowper Kreston. So I think if you sort of watched the budget yesterday, they kept talking about the E's, the 4 E's, enterprise, employment, education, and everywhere. And so I think for our discussion, if we can sort of structure it perhaps around those E's, there might be another one that the Chancellor didn't mention yesterday, but we'll come to that later on perhaps. And there are a few sub-themes as well, so things like sustainable growth and the innovative and creative sectors. So if we sort of put a framework around that and start off perhaps with enterprise and innovation. So the Chancellor said that this is a budget for growth with a significant focus on enterprise. So the first question really to the panel is, how do we think that this is going to impact our clients and in the local area where we're based? So Alan, perhaps if you can take that one first.
I thought it was really interesting that most of our poll respondents put indifferent to this, because the first bit of my notes on this say mixed bag. So I think there were some decent positive measures for business and for enterprise, particularly some of the measures to get more people back into work, and I think particularly the childcare, the boost to childcare. So, that certainly should help. We'll talk later about the pension measures and to what extent we think those will help. But I do think business generally will be really disappointed with the failure to row back on the corporation tax rises. There was, I think, one of the Alexes mentioned a lot of lobbying around that from the CBI and others. So that being confirmed at 25%, I think will be pretty disappointing to a lot of business owners. There are some good things for investment, particularly. Alex talked about some of the measures around capital allowances, or under a somewhat different regime. But as we said, a lot of that just felt a bit like repackaging of existing release that are available, and perhaps only the really largest corporates or really capital-intensive industries are going to benefit from that. There was, however, some good focus on particular sectors. Innovative, technology-based, and creative sectors certainly had a lot to see. I think we've got a bit of talk about R&D tax credits that we certainly should talk about, and some medical and life science, some boosts for those industries definitely, and I think also for creatives. Mira, you picked up some things yesterday.
Yes, I think it was a good headline to say that it's gone up. The film tax credit has gone up from 25% to 34%. But when you actually go into it, obviously the name has changed from film tax credit to audio visual expenditure credit. But if you compare the two, the current credit system and what's going to come from next April, we looked at some calculations, and in fact the production companies, so film production and gaming production companies and high-end television companies will only be better off around 0.4%. So basically what really has changed is the name's changed, and how we're going to report and calculate it has changed, and also how we're going to report in the accounting system has changed. And obviously they're going to announce or more details to come in July, so we're going to keep an eye on it. What hasn't changed is they're keeping the core expenditure 80% cap. That's he has not made any changes to that. One of the interesting thing, I think, for our clients, as a lot of our clients were looking at other European countries where the headlines says that you get 36% or 32% in so many different countries. But the Chancellor did say yesterday he's bringing the tax reliefs and most of these credits in line with the other European countries, and I believe this is in line with that. In that perspective, yes, it is good. It is a good announcement, but more details to come. But what it's not good is, as it says in the headlines, and a lot of my clients did get confused about it, is the headline says film tax credits gone up from 25% to 34%. It's not simple as that. We need to go into it in more detail.
And I think we saw a few of those.
Yes.
And perhaps we shouldn't be surprised that the Chancellor would try and make things sound as positive as possible. And the more you look in, the more there was repackaging and perhaps things that weren't improving quite as much as.
Well, we do. All the other countries, the European countries, who say they give 36% or 40% or whatever, but when you actually look into how they calculate, I don't think we'll be far more different to how it's done.
Phil, did you have any?
Yeah, I was going to say, I think on the R&D front, it's that same piece about not looking or having to look past the headline. The headline sounds great about this enhancement that will be available to quite a targeted audience. So actually, when you actually look in the detail and go, right, but it's really targeted at loss-making businesses. And the key thing for me is it is that row back on what happened in the autumn statement. Whilst the headline is a £500 million kind of giveaway, actually the benefit is just putting people back into close to, but not as good as, the position that they would have been in had the autumn statement not taken place. I think the other thing is that for most of our clients who are profitable, who qualify for R&D, actually they're still going to feel that pain. There is still no change to the rules that went through before.
I think one of the obviously we've got an increase in corporation tax up to 25%, but actually if you look at the tax revenues overall, the biggest driver of tax revenues is going to be income tax, national insurance. Corporation tax, even at that sort of higher level, is still only going to generate about a third of the revenues of the income tax and national insurance. And obviously, we've got some significant stealth taxes that we'll come on to in terms of income tax and NIC, which are going to continue to impact those unincorporated businesses, which we just got to obviously be mindful of as well.
So Phil, I think R&D is obviously one of the key areas of concern for our clients, and therefore could you explain a little bit more about the new R&D intensive business relief? I know Alex has sort of given some headlines, but if you could go into a bit more detail perhaps.
Yeah,
about
of course. So I think the key thing to think about here is that there are a lot of changes. When you combine the changes from the autumn statement plus the changes from yesterday, I think businesses have got a lot to grapple with to try and understand what all of those changes mean for them. The element that we're talking about for profitable businesses is this reduction in terms of the benefit. So it comes down from close to 25% benefit down to closer to 21%. So that's where if you're not qualifying for that R&D intensive business, there will be a reasonable kind of reduction in the benefit that you obtain from R&D. All of this is geared around this idea of trying to prevent abuse of that SME scheme, and alongside that bringing RDEC up to being more comparable. So I think it is still positive for larger businesses that RDEC scheme is moving in the right direction. I think it's important to understand that this is quite targeted. So the 40% threshold becomes really important. You can imagine a scenario whereby actually real-time R&D will become really important. That idea that throughout the course of the year you are really tracking how much of your R&D is qualifying versus non-qualifying, so that as you get towards those later months you can start to make some important decisions, because being either side of that line, if you are on the cusp, could be really important. Look, this doesn't get businesses back to where they were before, but it is helpful for those that all qualify.
Do we know whether the 40% is a cliff edge? There's no tapering, it's just you're either in it or you're not in it?
Yeah, it appears that way. And I think one of the things is that it'll, as far as we're aware, it'll apply on a year-by-year basis. So you'll certainly have a scenario whereby potentially early-stage businesses that could qualify for it, as they progress from being in that kind of development phase into commercialising their R&D, you could see a shift of actually qualifying initially, but then subsequently falling away.
And a risk, as we see in so many areas, of tax driving, commercial behaviour, where businesses have to try and cram in a certain amount of development costs into the right periods just to get over the line.
Yeah,
which can be a challenge.
And I think the other thing that's important to note is that this will apply on a group basis. So this isn't about being able to go, right, I'll ring fence my R&D into one entity within the group. There will be a concept of kind of looking across the group to kind of prevent abuse from that perspective.
It's interesting that for this, particularly in the R&D, the focus has been on the larger corporates, and often the government very much tries to focus on small because the small businesses drive the economy. What's your take on that? Why are they focusing so much on large companies, do you think?
I think a lot of it is driven from that abuse concern. I think, R&D has been such a popular measure, and I think we see it that there are claims that you kind of have awareness of that go through, that you sort of take a step back from and really kind of go, right, is that really considered to be R&D based on the kind of strict definition of the law? So I think from that perspective, it's largely around trying to clamp down on that and make that SME scheme not quite as attractive. I think the final thing is that, like Alex mentioned, if there is an intention to eventually merge these two schemes together, trying to balance the two becomes quite important ahead of making that transition.
Okay, in terms of indirect taxes then, Mira, perhaps you can come in. Can you pick out any positives for businesses and individuals there?
I think the VAT threshold, I think, as all the other taxes, it hasn't gone up. It's been frozen. So it is in terms of indirect taxes, in terms of VAT, it's good and bad, because the threshold hadn't gone up, and the last time it went up was back in 2017. But this is going to stay at the same threshold till March 2024. So that hasn't, that some businesses might say it's okay, but the fact that it's not going up is going to capture more businesses to be VAT registered. But in terms of duty, as Alex mentioned before, it's going to encourage people to hopefully to go into the pubs more, and obviously, you know, their profits will go up, because I don't see them passing that down to the public. You know, they're not going to decrease the pint of beer prices. So because that sector has been suffering for a bit. So, you know, it is quite good to encourage local businesses and the local pubs in that way. But in terms of, is it positive for VAT and other duty? The duty sounds, you know, obviously the fuel duty and all of that is there. There's some of the stuff which is going to help the drivers. The alcohol, you know, they announced that in the last autumn, I think it's November, it was announced that, you know, they're going to calculate the alcohol duty based on the strength of the alcohol rather than having this complicated system. So obviously some, as we were discussing earlier, like, you know, whiskey drinkers might not find it very useful that it's going to be higher than the beer drinkers, but it's like, I suppose that's the right way to measure it. Yeah, so I think around the threshold, if I expand a bit on that, there are positives and negatives, because if the VAT threshold has gone up in line with inflation, it would be 103,000 currently, but it hadn't gone up. So from that you can see the difference. They know how many businesses are going to get caught in that to be registered for VAT. But a couple of years ago, or even a year ago, there was a rumor that they were going to bring the threshold down. So at least that didn't happen. So that, you know, that's a positive. And when we were in the EU, we were the highest threshold in the European Union, and we still are the highest among the European countries. So it is good that way, because some of the European countries' VAT threshold is 15,000 euros. Yeah. So, you know, compared to where we are, it's okay, but it's not all good in terms of, because they're going to capture more businesses into it. Yeah. So maybe smaller businesses are going to be registering more.
And there's a wider theme with that, isn't there? We saw a lot of things that didn't change. You mentioned, you know, the VAT threshold not moving. With inflation, it just drags more and more people into that net. I think we'll talk later about, you know, fiscal drag generally. Yeah. But even those small measures on freezing fuel duties, on reducing beer in pubs, is that really not just picking away a little bit at what we're losing through inflation and through you know, price rises? It's just taking the edge off some of that rather than being.
It is definitely, and also it's just giving a bit of a, it's you know, a little bit of positive news. I think it gets people into the pubs really, well,
like, you know, that's you know, Mr. Hunt's job, isn't it?
Exactly.
To make it look good and make it look appealing. And,
yeah. So I think entertainment business, especially the pubs, and you know, they would have welcomed this, and they did welcome this.
Good. And Sharon, I mean, another theme from previous budgets has always seemed to be companies incorporating. It's beneficial to incorporate. It's beneficial to make profits in a company. I get the sense that that's sort of changing now with some of the rate increases and corporation tax rate increases. How do you see it in terms of some of your client base, in terms of their businesses and some of the key considerations going forward?
It's more complex. So actually all we've done is created less certainty, more complexity and more number crunching, which you know, I know we like a little bit of number crunching, but actually there's a little bit of head scratching that's going to go with it. And yes, I think, you know, the additional corporation tax, as Alex has mentioned, depending on what rate you're extracting your money out of, if you're in a company, can make a company potentially less attractive if actually what you want to do is take your money out and spend it. Mm-hmm. And I think that's always the challenge of actually, do you run as a company, do you run as an unincorporated business? And if you have an unincorporated business with multiple partners, all of whom have got multiple personal allowances, basic rate bands, etc., and actually want to spend the money, then actually that may still be an adequate vehicle, as opposed to the corporate route, and so I think actually it's slightly less attractive now, incorporating and having some of the obligations, but very much, as Alex mentions, down to personal circumstances. But it's certainly not a straightforward, easy answer of company or unincorporated and dividends or salary question that we've probably wrestled with in the past.
Yeah, for a while it certainly was quite straightforward, and a corporate client said dividend or salary, the answer was fairly obvious, and
absolutely.
It's now not again, and it sort of takes me back to some of my, quite a number of years ago now, when I was sort of learning tax, and you sort of had to do lots of calculations about sort of corporate profits and marginal rate bands and bonus down to a certain level, and then paying dividends after that, and that sort of thing.
And I think if you hang around in tax long enough, you tend to see the things you might have seen 30 years ago just revisiting. So I think we're back into that corporate regime that we've seen in the past, aren't we?
Agreed.
Yeah. And Phil, one of the other areas that used to be relatively straightforward, again going back to my exam days, sort of however many years ago that was sort of capital allowances, and Alex has again set out some of the sort of rules around capital expenditure. They sound much more complicated now in terms of working out which bit you fit into. Can you just take us a bit through those in a bit more detail?
Yeah, of course. So I think it's important to pick up on some of the things that Alex highlighted. So for unincorporated businesses, there is still only available the annual investment allowance. And actually for corporates, annual investment allowance will still become quite powerful because it does spread across both your main pool and your special rate pool. So in terms of the assets that will qualify up to that £1 million limit, that still is probably, for a lot of our clients, one of the more powerful tools that will be available. I think the full expense relief, in terms of kind of creating that, it's badged as this new kind of initiative. The reality is that it's probably just the super deduction in all but name in terms of the relief that it provides. I think for businesses, one of the big things is a bit about kind of stable rules and understanding what that's going to look like for the future. So to have that mapped out for at least 3 years, in terms of knowing that that's what's going to be the rules, that I think will give businesses longer to sort of plan and make some kind of future investment decisions. Obviously, they made the announcement that they want to try and continue it beyond that, but at least the 3 years gives some certainty.
And there's been a real lack of stability in rule setting for the last
Agreed,
year or so. It's been very difficult for business.
And one of the things that we have to be aware of is that there could be a change of government at some point in the future. I think it's helpful that Labour have hinted that they would be happy to continue following the kind of the capital allowance regime that's currently in place. So I think, again, that provides businesses with a bit more stability for the future.
So I don't know which of you would want to take this first, but I think the Chancellor was suggesting yesterday that the UK is still a competitive place for businesses to do business in. Do you agree? Is he right to say that?
It depends what you compare against. Certainly headline corporation tax rate much higher than it was, but still low comparative to most big economies.
Well, and I think on that, if you compare it to the G7, the point was that it's the lowest of that group. I think the challenge that we will always have is with Ireland. In terms of that, I think the intention is that will move to 15% as part of the minimum worldwide tax rates, but that kind of 25 versus 15%. Given the location and the proximity and the language.
Access to the EU markets.
Agreed.
But I think also with that, it's very easy to just get hung up on the headline corporate rate, because actually you've then got to look at getting money out of a corporate, and actually that may not be as cheap in places like Ireland as it is in other jurisdictions. So you can't just look at one side of that, you have to look at actually the whole.
Yeah, and we see a lot of businesses who do look past that initial headline rate. If you are a capital intensive business, this new full relief for all your expenditure does help significantly. And I think when you look at the monetary values that are placed on this in the budget, there was a £15 billion swing for the increase in the rates in, I think it's 24-25. but actually this kind of full expensing is expected to kind of give back 10 of that.
Yeah.
So there is quite a big shift in terms of that dynamic.
You've got to think that's going to be particularly good for sort of renewable energy, wind farms, nuclear, those sorts of things where, you know, tens of billions of pounds is invested up front.
Yeah.
That's got to help in those areas.
But also in the entertainment side of it, where the film production companies and the gaming, companies, they all, a lot of the international production companies do come to the UK, and they were all quite anxious about what was going to be announced in the budget. But I would still see them coming in. Because UK is quite attractive to many of the production companies. The reason is like, the language, and now Shinfield coming up, and then a lot of studio spaces and all of that is only going to create, and for those, for anyone in that sector, I would still see international businesses coming in.
And of course, we didn't see any changes in the non-domicile regime as well, which actually is
so
a key part of the entertainment.
Yeah.
Some key non-tax measures as well, I think, for innovative industries. Some big funding going into nuclear, into renewables. There was I think a £1 trillion, too many zeros to remember, pound fund for supercomputers for AI.
Yeah.
Big numbers that will encourage investment into those areas. And I think that aligns quite well with the relief schemes as well. I think, for me, the tax measures alone probably don't really move the dial very far, but quite a lot of investment being encouraged in the right sectors as well.
Okay, thank you very much. So moving on to the second E then. The second of his E's included a lot of changes to try and get people back into employment, moving off benefits, getting the over 50s back to work, some say older, some say more experienced, childcare allowances. So perhaps starting with you, Sharon, how do you think that these changes are going to impact the workplace?
Well, I think the main driver is obviously since the pandemic we've seen a larger fall of the economically inactive in this country. I think something like nearly 7 million people. And that compared to some of our competitors, it certainly fallen higher and for longer. I think at the core of this is obviously creating a strong labour market, building out the economy, and in reality there are two pillars to this. One is reducing the people who are on benefits, and finding a way of encouraging people into the workplace, and also bringing those who've left the workplace, particularly through the pandemic, back actually in, and through that we will see an increase in tax receipts. And as I said earlier, income tax and national insurance are the big drivers of the economy. So getting more people actually into paid work will inevitably increase those receipts and reduce those benefits. So you can see what the Chancellor is trying to achieve. As you say, there are the support packages for helping people with long-term illness and disability, so that actually they're removing the barriers to encourage them to come back into the workplace, which I think is great. There's an element of, more stick for people who are actually in receipt of benefits to make staying on those benefits and not working less attractive. So that's sort of really focusing on that side of things. Childcare, we've talked about childcare, and there's a huge amount of headlines on that. And overall, actually, that's very positive. It will enable people to come back into the workplace and be economically active at an earlier stage than maybe they will. And certainly, it allows us to keep skills actually in our businesses, and probably proportionately women are the ones who are actually taking those career breaks still. So we're losing an enormous amount of skilled females who will come back in with the right sort of support. Clearly, those childcare benefits are not going to be coming in anytime soon. So they're going to be phased in from a year out. So it's going to take a time for that to sort of come through. The main bit actually is really on the over 50s, bringing the over 50s back in, and the big sort of driver, apart from the sort of the support for those over 50s with additional support to find work, and also this new phrase of returnerships. So the apprenticeships for the older, that's all great. We can talk about whether we think it's going to sort of benefit. The big bit is actually the pensions changes, which Alex has headlined, and that feels very focused on public sector, certainly the NHS, but actually bringing public sector back into the workplace where they've maybe benefited from a final salary pension scheme as opposed to a defined contribution scheme. But it will actually have the benefit for a lot of people. I guess the bit with abolishing the lifetime allowance will actually allow people to put more funds actually into their pension, providing they can work within the less restrictive annual allowances that would have been announced. But it's quite interesting because obviously the bigger the pot you build up, then there's two key things to watch out. Is one, when you start drawing that bigger pot of money, you're going to be paying income tax, so there's going to be an increased tax, so yes, you might get the ability to put more savings in, but at some point those potentially going to come out. It also creates a big pot of money that actually can be passed on to the next generation, inheritance tax free, and I think that's probably going to be a political loophole that certainly Labour have already said they intend to change that. So I think there's a window of opportunity to put more funds into a pension. But actually what that looks like if you do that in the future, if the landscape changes, the political landscape changes, you obviously have to do that with one eye open. We're talking about bringing in, maybe 15,000 people back into the workplace. So it does seem to be quite a beneficial change for what appears to be quite a narrowly focused and very small group of people coming back into the workplace.
I think it's an easy sort of headline for papers and opposition, just to the 1%, the very wealthy, the fat cats, whatever terminology you want to use. But this for me is focused on experienced doctors, head teachers, senior civil servants, that for the last few years with what some would say is sort of fairly prohibitive pension rules, it's just not been worth them continuing to work. You get to a point in time and the marginal benefit from working for another 2 or 3 or 4 years at that stage of the career just isn't worth it. And hopefully this will change that and keep those really valuable people, particularly in the public sector. We all know how much the NHS is struggling for resource, how difficult it is to recruit and retain teachers, and hopefully all of this will just move the dial in the right direction.
And I think that's right. I think it's keeping people in the workplace. To what extent it's bringing people back into the workplace who've retired, I'm not sure.
Yeah, I almost heard it more as keeping. The way it was dressed up was yes, people who perhaps retired earlier. I think this is about stopping people retiring for the next 3, 5, however many years.
Well, I think on that, I think for our clients, I think it's important to remember that that retention piece still becomes really important.
Absolutely.
But retention isn't just financial. It's what other benefits that you get. It's the working environment that you allow people to be in. I think we need to be mindful that this isn't going to keep people if one of your core challenges is that piece around retention.
And I think just picking up on the tax-free lump sum, so although we're getting rid of the lifetime allowance limit, and as Alex mentioned, the amount that you can take out of your pension pot is still going to be restricted to 25% of the current lifetime allowance, so the 268,000. But for those people, my understanding is for those who have already fixed their protection, if they can access a higher amount under the fixed protection they've got, then those benefits will still be preserved. It's only those who haven't fixed that will be restricted to that 25% of current lump sum.
But all those experienced civil servants and public sector workers, even if the private sector want to now employ some experienced people, I think there is an opportunity to, you know, I'm also looking at those things to see, as much as it's a retention thing, there will be a lot of experienced people out there, hopefully wanting to come back to work.
Yeah. Super. So we've done 2 E's so far. Before we move on to the other 2, just a reminder to people who are watching, if you do have questions, then please do submit them, and we will have a bit of time for questions at the end. So the 3rd E was education, and it wasn't really what we typically considered to be education. It was far more about sort of the early years childcare, and I think we've sort of covered that already.
Yeah,
I don't know if anybody's got any comments, but
I think for me that was a bit of fluff, really, wasn't it?
Just to get the 4
get the 4th E in. These were more workforce measures and enterprise measures to get people back into work. There was really nothing for education that I came across.
Yeah. So the 4th E was everywhere. So what did we make of that as a panel?
Everywhere except here. Most people watching will know that we're a regional firm, focused on clients in the south of England, the Thames Valley, south coast, sort of around London and the home counties. Not much mentioned for those regions and geographies. I think there was 12.
We had potholes.
We did.
It was only in Wokingham.
Only in Wokingham.
But there was, I think there was 12 regions, eight in the Midlands and the North, 1 in Wales, 1 in Scotland, but nothing, within 100 miles of here. But important to note that the sector focus of the budget was really good for the geography and the sorts of clients that we work with. Innovative industries, biotech, pharma, particularly around sort of Oxfordshire area. And those sorts of, so although we may not have liked the geographic focus much, I think we did like the sector focus quite a lot.
And I think that sort of tech sector, and one kind of fairly narrow thing that I noticed is a change that's coming through for self-assessment tax returns to put some separate pages for crypto assets on. So in due course, I think that's due to raise an extra £10 million a year just through putting a new page into a tax return. So I think there's probably a little bit of a warning as to where we think that technical sector's going.
We've seen how complex that can be, and I'm not sure, you probably know more than I do on this, but do we think a lot of people are just missing it from tax returns innocently because they just don't? So I'm sure, as ever, some people will be choosing not to report crypto gains, but I do wonder if it's just not on people's radar, and maybe just by putting the box there, it might capture people who just forget about it otherwise.
I think there's that. I think there's a political change as well, and I think, a few years ago, the US, the IRS, moved crypto reporting to the front page of their tax return. So I think that's kind of indicative of its becoming more mainstream and it's being elevated. And I think it's really about reporting so that actually they can press a button on a computer and they can actually pull the reports specific to crypto. At the moment it goes in the other bucket, so actually it's very difficult to get an understanding of that landscape.
And to understand how much enforcement is worth throwing at it and that sort of thing.
Correct.
Correct.
Okay, so everywhere, but probably not much around here in terms of high-level stuff, but obviously looking at the detail and the R&D particularly in those sorts of tax reliefs.
I suppose also we should recognise that it does fit with the levelling up agenda.
Of course,
and I think that there's been a lot of criticism of that having been forgotten. It was a great election winner, then they've done nothing with it, but at least now they do seem to be back on that track.
Yeah.
Okay, so that was 4 E's then. Perhaps we've got a 5th one. Perhaps it's the elephant in the room. Just have that 5th E there. So I think in the newspaper headlines, and Alex also mentioned a bit, there are a couple of other things that have been mentioned. I think a can't remember which paper it was now that focused on the stealth tax rises.
Yeah.
So perhaps the elephant in the room.
Yeah,
I don't know, Alan, do you want to start off
yeah,
on
I'll
this?
start. Yeah, I think I either read or heard last night that on average we think people are going to be 6% worse off over the next 12 months. That wasn't mentioned in the budget,
No.
perhaps unsurprisingly. There was a lot of focus on getting inflation down. I think Jeremy Hunt said hope to get it down to under 3% by the end of the year. But by then it'll have sat around sort of 10% for best part of 2 years. So huge increase in just in the numbers just get bigger. All of the things being equal, costs and incomes are going up significantly without moving any of the thresholds essentially.
Yeah.
So really substantial tax rises. All of the things being equal for ordinary people.
And I think I was looking at some of the numbers just in round terms yesterday, and I think with the freezing of the personal allowance alone, you're everybody, certainly those who are earning more than sort of 40,000-50,000, we're going to be having an extra £500 a year in tax just through that. The bringing down of the additional rate threshold to 125,000 is going to collect more than £1,200 a year. Bring that threshold down, interestingly, that will mean that more than 11% of the population will now be in that 40% tax bracket. So this is no longer a higher rate tax bracket just for the wealthy. Actually, it's bringing a lot of the sort of ordinary workforce actually into there. The capital gains tax threshold changing from 12,300 down to 3,000 means that you're potentially paying an extra £2,000 in capital gains tax next year, and up to £3,000 in capital gains tax a year after. And the other one, sort of the inheritance tax nil rate band, that has been frozen for many years at 325,000. Well, if you increase that by inflation since it had been frozen, you'd be at probably around about £500,000 by now. So we've got an effective kind of £60,000 inheritance tax take actually in there just through the freezing of that nil rate band. And an inheritance tax now is forecast to go up to about £6 or £7 billion this year, predominantly fueled by increasing house prices and that inflation.
The one for me is also remembering that 100k threshold at the point at which people start to lose their personal allowance.
Absolutely.
You all know the numbers. It becomes a very expensive marginal rate.
It's a 60% marginal rate if your income is between £100,000 and £125,000. So
there's going to be a lot more people that, with inflation, like you say, inflation running at double digits, that will now find themselves in that bracket.
And that's where things like having the increased pension annual allowance actually could be helpful, because actually, if you can get tax relief on that pension allowance at 60%, by moving people out of that window, then that's where we can actually be very creative.
But it makes it ever more complicated. Again, and for most employed people earning a middle wage, their tax bill is going up very significantly. I think also we need to remind people that these thresholds aren't planned to move for another 3 years. They'll have been frozen for 4 or 5 years. I think 4 years by the end of that. Wage inflation, price inflation could easily be 20% plus over that period, and no increase. So a really large increase in the tax take.
But the hidden, as usual, it's just the hidden nasties actually, because you won't, there's no headlines. There was nothing about tax rates really in the budget.
But the reality was that no change was actually a really big change in reality.
Yeah, absolutely.
Which, surprisingly enough, the government didn't want to make too much noise about.
And it's exactly the same with the VAT threshold, as Mira mentioned earlier. That not keeping pace with inflation just means that more people are being brought into the VAT regime with the cost of actually operating that, and also more of the public are having to pay an additional rate of VAT on purchases.
Yeah, and also I think is one of the things which disappointed me was that Chancellor was saying it's all about the speed. You need to get everything done quickly and all of it. It was the days of getting a VAT registration done in days or even weeks. Now we are waiting for 3-4 months for registration. And there was no talk about how they're going to speed that up. So, the more businesses are going to get captured into this 85,000 threshold, a lot of the small businesses are going to come in, and as we are experiencing and many others are experiencing, we've been waiting for VAT registrations to come through for 4, 5, 6 months. So, it was disappointing that he didn't talk about, even though, yes, it's all about speed and we're in line with the other European countries and all of that, and how are we going to, because we all know there is a massive shortage of staffing in HMRC. There was, those things weren't addressed. So it is like,
And I think there is an appetite to try and actually create more digital accounts with the revenue and have more digital interface, which I think is laudable, but actually the digital interfaces we've seen recently actually have taken us a step backwards. So from an agent perspective, being able to actually support clients, you have to sort of have multiple different digital accounts. So if they can bring that together and you can sort of operate that way, that's great. However, we've also got to be mindful of the impact on the digital excluded people as well, and businesses.
But like, VAT registrations moved to digital, online registration years ago. You can't submit a paper registration. So it moved years ago, but still there is now that there's longer delays getting longer. So these are the things which wasn't discussed yesterday, but it was like
pragmatic challenges.
Exactly.
And the longer that threshold doesn't move, the more kind of plumbers and electricians is just
They're gonna get caught,
one person and apprentice type businesses that were never intended to be in the VAT
exactly.
net and are now firmly in it.
Correct.
And then having the right software to submit it and all of that, they're going to incur more cost.
And on the corporate tax side, Phil?
Yeah, I think it's a similar theme, isn't it? Which is that we've got these kind of the rates. It's unfortunate that the Chancellor didn't choose to do something more to alter where those rates kick in. 50k is a very low threshold for businesses, and it would have been nice to have seen that move.
Okay, thank you very much. Just before we finish, any final sort of comments from any of the panel members? I mean, it seems to me that a lot of the planning that we've done in the past that we haven't had to do for the last few years is back. There's a lot more complexity. Perhaps a couple of any key takeaways for clients who are listening in terms of what they need to do.
I think for me on the R&D, that real-time R&D is really critical now. If you're a R&D intensive business that's going to be close to that kind of threshold, and you can look at past years to sort of analyse where you think you're going to be based on prior year data, keeping on top of that as you go throughout the course of the year will be really important.
Yeah, and I think we've seen a lot of R&D tax credit claimants sort of look back 18 months, 2 years, and I get the sense that that's got to change, and we've got to have a much more real-time approach to that. And then the other thing is the age-old bonus and dividend question that the other Alex touched on. We've had a few sort of decent years, haven't we, of knowing the answer to bonus versus dividend, fairly instinctively, and that's So encourage all business owners to rethink that. Particularly, we're coming up to a tax year end, in 2 or 3 weeks' time. It might be that the right answer for doing a bonus or a dividend pre this might well flip, so that all needs to be looked at really carefully.
I think that's right. I think also looking at the structure of your business, incorporated, unincorporated, how you structure your remuneration. For me, make sure that you use your capital gains annual exemption this year. Use it before you lose it. It might only be a few £1,000s, but actually it would be sad to not be able to utilise that.
And although I think that the pension changes don't kick in theory until 6th of April, I think they've still got the 3-year look back potentially.
Correct.
So there could be opportunities to get more pension contribution in the next 3 or 4 weeks that people didn't realise they could do.
And on VAT, I would just say that, start thinking about it earlier when it comes to registration because of the delays and everything else. And with all the film sector people, watch the space. It's all good news, but I would say in terms of VAT duty and also sector-specific watch the space.
Yeah.
Okay, well, thank you very much to everybody. We've got time for a couple of questions. We've got a couple of questions come in there. So I think the first one, and I think it might be that Phil's best placed to answer this. So in terms of thinking about the R&D and the 40% qualifying expenditure, you might have answered this already, but do we know how that's going to be measured? Is that just on an annual basis, financial year basis?
Yeah, and again, I think we've sort of touched on this. It's in the detail, and we don't have necessarily all of that detail, so it's not. Yeah. You know, there's a lot of a big question that goes into what is expenditure. Certain businesses will capitalise some of their R&D. Our understanding is that that will still qualify. So when you're looking at, it's not just necessarily looking at your profit and loss account. It's looking at your capitalised R&D, and then what might happen with add backs. You know, if you've got, you know, we've obviously got things like depreciation and entertaining and those sorts of different add backs. We're not quite 100% sure how that will come through, but it will be on a year-by-year basis as far as we're aware, so that kind of idea of continuously monitoring it is important.
Okay, thanks. And another question that's come in.
Also for Phil.
Also, well, I'm just having a look at some of the questions. They're flooding in now. Lots for Phil, but hopefully a more straightforward one. Do we know whether vans will be included in full expensing, or again, have we not got the detail on that yet?
Based on how it worked for super deduction, commercial vehicles, you have to be very careful with those crossover vehicles, so pickups, for example. But genuine commercial vehicles, vans, lorries, should all qualify. The one that won't is cars, that they need to be kept separate.
Okay, and then there's another question that's come in on the pension allowance increases. Sharon, it might be one for you. Do we know whether the 60,000 will apply from 23-24, or does that apply for the 22-23 tax year?
It's from 23-24.
Okay, so yeah, from 6th of April going forward.
Yeah. Yes.
Thank you very much. And I think there's another question about R&D. I think R&D is going to be popular. Do we know whether overseas expenditure will count towards the 40%, or again, you might not have the detail?
Yeah, it's a good question. I don't think we know. I suspect that it will. I think if it's overseas expenditure and it's kind of wrapped up in, I think it must do. If it's going to form part of your claim, then the likelihood is it will count towards that.
That's my expectation as well.
Yeah.
Okay, well, we're nearly at time. Hopefully the audience is still there. We've got one more question, so we can see if they're still there or not. One more question before we wrap up. So the final question then is, how have the announcements in the budget affected your confidence in making business investment decisions? So for business owners out there, how have the announcements affected your confidence really in making decisions about your business? So if we can launch that poll, hopefully, and get that one live. I think that poll is just going to be coming up there. I can see it on my screen, so hopefully that's going to be launched. So if you can vote in the same way as you did before, but it's open now. I can see people coming in there, so it'll be interesting to see, given people's views on the overall budget earlier today, whether actually that has been positive for them, for their business as well, and helped them make decisions for the future. So we'll just get a few votes in there. Hopefully, it looks like quite a few people are still there, which is good. An hour or so later, did wonder, because it's hard for us to tell sometimes. So we'll give people a few seconds to vote. I think they are coming in, and it's fairly steady, I think, the result there. So we'll give 10 more seconds. No more votes coming in. So I think probably not surprising, given the initial vote on the effect on businesses and individuals earlier. So 24% of people think that they've got more confidence now, so it's increased their confidence in investment in their business. 75% actually it's made no change whatsoever, and at 2% their confidence has decreased. So actually either positive or indifferent, I think, is the verdict on that.
Which is pretty similar to the verdict from the start.
It is fairly similar to the verdict from the start, so I guess that's not too surprising. So thank you everybody for attending this webinar this morning. Thank you very much to the panel, to Sharon, to Mira, Phil and Alan. Thank you to Alex, and thanks also to everybody who's been involved in putting this on today, the team behind the scenes and the team here today. Please do get in touch with us if you'd like some more information. If you haven't already got the message, actually one of the things from this budget is actually things are going to be a bit more complicated now. Things which were straightforward, like shall I pay myself a dividend or a bonus, or what are capital allowances, for example, it's not quite so straightforward now. So I think there's lots of discussions to be had, so please do get in touch. As I mentioned earlier, the recording will be available, and I believe we can also circulate the slides to everybody who's attended as well. I know somebody asked that as a question, so they'll be available to you as well. So thanks again, thanks for coming, and I look forward to seeing everybody either online, via Teams, via Zoom, or actually in real life very soon. So thank you.